today's conversation, I'm going to take up the topic ego and portfolio repair. When we buy a new stock idea and then started to like it even more, we keep on adding, we keep on buying the same stock more and more. We start building volume, we start building a big position size. From the time you like an idea to the time the position size of your ownership becomes significant, one thing happens. Your ego starts building up and starts dominating how you start viewing this stock. Your entire perspective about the stock, which was from a distance before you came to know it, becomes deeply personal after you have bought it in volume, in quantity. If bad luck hits you and you have bought the wrong stock to such a quantity that you're not sure what to do now, and then you become very, very insecure after you have bought a lot of quantity. This is where the problem starts. Your portfolio may need repair, but your ego refuses to allow it. So you are hoping that maybe there will be some rally, some idiot will come and buy, I'll sell and get out. At that point, you start believing in the greater fool theory to come and help you get out of a mistake that you have made. Many times, when we practice this, we run the biggest risk of being that greater fool, somebody who has already been fooled by somebody else. Because ideas come from different places, somebody has fed one idea on us or to us, and the idea has grown on us, and now the idea is consuming us in a very wrong way. Today, I'm going to discuss with Subra about his own experiences and how he dealt with this, because it's very normal for us as investors to find mediocre ideas, and there are times when we get into the wrong ideas or even bad ideas. Subra, ego and portfolio repair starts with a bad idea. So start from there and tell us.
No, it uh, not only starts from a bad idea, it also happens because you don't have rules for yourself. You may have rules for others, but you don't have rules for yourself saying, oh, now it will recover. So if I like the share at 100 rupees, I like it more at 90 and I like it much more at 80. Because then you say, oh my God, this is a great share, good dividend yield, I should buy more and all that. And suddenly you find that the EPS itself has disappeared. So there's no question of dividend and dividend yield. So these kind of things happen. So basically, in the market, the price is the only thing that you know. Everything else is your guess. So you have to accept that the market is trying to tell you something
Through the price.
through the price. That's all. It's not, I mean, maybe it's a great share, but it's not working in the market. So you have to have two types of, at least I have in my portfolio, two types of stop loss. I bought a share for 100 rupees. It goes to 90. In most cases, I would sell it off because something the market is telling me which I don't want to hear or listen. And the second stop loss is if I give it time. So I bought it at 100 rupees. It is at 100 rupees for 6 months, 8 months, 1 year, 1.5 years. Then I lose patience and I sell off. Maybe I'm wrong. Maybe it will recover. But in most cases, it is better to look for a fresh idea which will work. Unless I'm convinced that there is something extraordinary about this company, then I go around, talk, find out about it from other people. And if I can't get convincing answers, one thing I've always felt, if you're trying to buy a house in a place, go and tell a broker there that you want to sell a house. Then you'll say, oh, nothing can be sold here, it is a bad place, nothing can be sold, etc. And then you tell him, no, actually I want to buy. Or you go to another broker and see what all he says. They always tell you what you want to hear. or they try to make it more difficult and say, look, I'm making it easy for you. So you will always hear those kind of things. So when you find a good company or you think it's a good company and it is not working for you at that point in time, maybe later on it will work. You have to, with tremendous rules and regulations for your own self, you have to get out because it's a 10% loss. It's as simple as that. Maybe the same idea, you bought the share at 100.
You're saying
you
you'll
sold
control
at
a bad idea through stop loss.
Absolutely, because
But what about those who don't do stop loss? How do they psychologically take care of this? Some
no,
people,
then they don't. Then they just wait, because somehow there is this theory called my price theory. So even if they bought a share at 100 and then it goes to 170 or 180, they don't sell. And then when it comes down, they'll say it will not go below 100. Because they think the share knows the price at which I bought, and they think it will not go below that. Then they will wait, 110, sell off now, no. And then when it goes to 100, they will sell off. Or sometimes they will not sell off even then. And then the price comes further down and they no clue. See, if you don't know why you bought, how will you know when to sell? If you bought to keep it for the rest of your life, then it has to be a fantastic share with a good dividend yield.
Agreed.
Some story has to be there. If there is no story, nothing is getting built up, what will you do with it?
Fair enough. So you are saying that you cannot storify on your own, and sometimes the market also may not storify your idea just because you bought it. Your price doesn't matter. If the idea is wrong, you have to sell.
You have to sell. There is no choice.
So, from your experience, suppose you have sold the stock. You are saying 10% I sell now. The stock again goes up above your cost and goes another 20% above the price at which you sold. And then again you are hearing good things. Will you again go back into that stock?
Yeah, I treat them as separate transactions. Let's say I bought the share at 100. I sold it off at 90. Then it goes up to 95. Does it mean I won't buy it? I may buy it.
No, but you hear that the company is a bad company, but the price moves up. Will you buy it? You are convinced that the company or the management is not a good, reliable entity.
No, then I won't buy it just because the momentum is there. Because I've already suffered 6 months, or I suffered 1 year, nothing has happened. Then you hear the company has done this, or you hear it from a broker. You know who is rigging the share price. There are such brokers. When they call you and say, oh, this share is good, you know something is wrong with it. I remember, I'm not naming the company, I bought that share at I think it's 72 rupees. Then I told another friend of mine who is also a broker, I said 72 rupees I bought because I think the management is going to take the share price up. Complete rigging case. And that time the price was 70. He said, hello, yes, it is going up. The going up is over. Now it is going to go down. I sold at a loss of 2 rupees. That share price then went down to 9 rupees. Right? So ear to the ground, somebody telling you a story, you will react. It is not possible that you don't react. You may react with a small amount and say, okay, let me take a chance. But you have to have your own rules. So if I had bought it at 72 and I had not spoken to my regular broker, I would have sold it off at 63.
Okay.
I wouldn't have waited it to come to 9 rupees. I wouldn't want to lose so much money in a bad decision. So I'll cut my losses.
So effectively, you use stock losses to cover your tracks.
Correct.
And to put yourself in a safe position.
It actually helps in 2 ways. If you do your stop loss, that share is out of your portfolio. Otherwise, you look at it every day and makes you feel bad. Idiot, you bought it at 70, now it is 60, now it is 50, now it is 40.
So you
it's
don't
laughing at you. It is laughing at you. I'd rather get rid of it and say, get out, get into the garbage can. I don't want to see it on my portfolio. Or sometimes, the market is not treating it well. You have to get out, wait for that to, I remember, let me talk about this share, which I thought it was a good buy at 107. Now I think it is down to 70 rupees, but at 95, 85 and all, I just got out. I said, something is wrong. I think it's a good buy at 70, but at 107, maybe it was not a good buy. So that I got wrong with the price. Good industry, everything, when everything else booms, I thought this industry will boom, but that particular industry is not doing well. So somewhere
when people buy a stock and it falls and then they hear that it's a bad company, many times their ego tells them that they should not make a loss in that stock. What will happen when?
No, see, this is the problem. If I have lost money in ONGC, I think I have to make money in ONGC. That is not true. You lost money in ONGC, you can make money in Coal India. What stops you? money doesn't know, your portfolio doesn't know where you lost and where you won.
So you don't believe in the theory that if you lost money in a stock, you must make it up in the same place?
You can't.
Or wherever you lose money,
Sometimes you can't.
you earn it back.
Sometimes you can't. And you're making money elsewhere because you look at it and say, okay, here I'm making 3 lakhs loss. Then you look at your total capital gain for the year is 38 lakhs. You say, take the 3 and pay tax on 35.
Correct.
That's it. You just move on.
Fair point. So you've seen numerous investors. Give us some examples where an investor lets his ego run too far and refuses to sell. Also, give me an example later about an investor who actually constructively uses ego. I want 2 examples of the ego. One not doing good to the investor, one actually helping the investor.
I really don't know whether it is only ego, because what happens is suddenly when the portfolio is not doing well, they're willing to listen to anybody. So if it's a woman, she will be listening to her husband. If it's a man, he could be listening to his friend. He could be listening to his broker. He could be listening to 3-4 people. Then he is actually confused as to what to do. Then if he comes to me, I don't want to become advisor number 4 or advisor number 5, so I don't say anything. I just look at his portfolio and say, it's okay, maybe you have to wait to do something like that and get away. Now I'm not even actively into consulting, so now I do not know whether things have got worse. So one is that. Second is people who are willing to say, okay, let me make the rules. Let me say, because your money doesn't care about your ego, right? So I keep telling this to especially those people who have inherited a portfolio. I tell them, if your father was here, he would have sold it. Don't keep it just because your father bought it and it was your father's decision. At that point of time, it was a good company. Right, I mean, companies.
Yeah, this is another issue which we have seen. Many people who inherit a portfolio, they refuse to sell, saying that, oh, my dad bought it, I don't want to sell it.
Yeah, but if you were still holding Nirlon and Mafatlal Industries and all, where are those companies? Those companies have been taken to the cleaners. Why would you still hold on?
Like you take even South-based companies, only 1 or 2 groups have actually done well, Chennai-based.
Correct.
The rest of all kind of vegetated. So if you are having a portfolio which your father built with all the Chennai-based companies, right, in which 60% are guys who are not doing well and 40% are these champs, you have a fair chance to get out of that 60% in a good market.
Yeah.
And put the money either in these champs or in some other geography, in some other thing. Most people, they just vegetate and they sleep through all this.
No, what happens, when you see old portfolios, 1 or 2 shares have done so well, it's like a big carpet under which all this can be hidden. So one Asian Paints, one HDFC,
one MRF,
one Reliance, one MRF has made so much money for them that family thinks, oh, he's a great investor. Maybe that was luck, whatever it is. Then keep MRF. I'm saying nothing wrong. Sell the others because it's already become a concentrated portfolio. You are already 90% in MRF and all the other kachra is only 10%. Don't sell MRF, but at least get rid of the others. Don't buy MRF with that, but buy, you can be single stock. You're just holding MRF. That's okay. But sell the others and put it into a mutual fund. Do something like that. This is not even ego. It is like saying my father was such a genius. He built this portfolio. Fine, he was, but he died. In fact, Shyam, I'm able to look at a portfolio, and when he says my father died in 2023, I know that from 2019 he has not been paying attention to that portfolio because last 3-4 years maybe he had Alzheimer's or some illness, so he's not looked at his portfolio. That is also visible that 2019 active management stopped. If you don't know how to manage,
2018 bull run stocks even today are lower than that price.
Yeah.
Similarly, 2023-24 bull run stocks are going to be lower for a long time.
No, but if he was a smart investor with the 2018 portfolio, he may have got out in 2018 or 2019.
Even 19.
He may have got
24 bull run stocks, even 26 they can get out and buy something else.
Correct.
But the ego saying that, oh, I saw that high price, today it is lower by 30%. Let me wait for that high price. That high price was, of course, not in the plan. It came outside the plan. Today's price is still a very respectable price compared to the cost. But your anchoring is to the peak price.
No, let us take an example only. Reliance Capital. We have seen it at 200, 300, at least at 150 we have all seen it. Today it is at 12 rupees. At some stage you have to get out. But if I ask somebody to get out today at 12, saying the price won't come, and 3 months later it is 24, he'll say, see, it has doubled. But he's not waiting for double. He was waiting for 137. So I don't know when it will go to 137. Whether it will go to 24 also, I don't know. But today I know it's at 12. My decision is I won't touch it at 12. But if you have bought it at 137, what should you do? I have no clue. this is not so much about ego also. It is like not wanting to look into the mirror, not wanting to acknowledge the loss. The loss has happened. If you don't sell it, it is still a loss. If you sell it, you're just acknowledging. You may actually be reducing your capital gains. Somewhere else you have made money, you at least set this off.
So at least tax efficient.
At least it's tax efficient to sell it off. And even you sell it at 12 bucks, and if it goes down to 8 bucks, you buy it back. If it's your ego which is
Now I am going to bring you to the next subject. That is, when you sell this kind of shares, some money comes out. What more needs to be done to repair the portfolio? Some liquidity we have got. What more can an investor do to repair the portfolio and bring it back to the pink of health, other than selling?
No,
or after selling?
After selling, when you have the cash, see, first of all, when you're 25 and you fool around with your money, there's very little you can lose. Out of your own money, you can still lose your father's money, that's a different thing, but you have very little you can lose of your own money. By the time you get to 50, you have to understand that this money is now required till you die at 90. Right? So this is now very important not to lose money. Not to lose money becomes very important once you have a reasonable size portfolio. If your portfolio is small, it is different. Now you have to protect it. I think it's a good time to seek advice and sit with somebody who knows the market, who knows you. But again, there is
you need serious counsel.
You need serious counseling, because what happens is, if there is somebody, it's your cousin or my cousin, they don't show us the portfolio, they think we'll be jealous or whatever. So within the family, nobody comes to show their portfolio and ask what happened. So that is again, I think, about ego, being secretive, not wanting to show. Don't come to me, but go to somebody else, have a health check. It is nice to have somebody else viewing your portfolio, because you will get biased. You will get biased. Get a friend, get anybody, pay professional fees, get it reviewed.
So the repair will start beginning to happen the moment you approach the right person who will give you an objective view.
No, the repair will start happening the day you know that it requires to be repaired.
Okay, self-awareness.
Self-awareness.
And then you go to a person. So the repair continues to that person. Then it again, once you're given decisions or suggestions, what should you do?
No, I am saying when you're protecting first of all, whether the man is earning or the woman is earning, this is the joint property of all the four. You have got married to a woman and she has had your children. So these four people are very important to the portfolio. And if your kids are above 14, 15, you can involve them also. Because here, it's a joint decision which you are taking, which will allow your ego to be held back and said, okay, not my ego alone, my wife and everybody agreed, therefore we bought, and therefore you can seek counseling. So first is self-awareness, bringing the family in and saying, look, I have been getting 9% return. This is not great. 7 is what we would have got in PPF or a bank deposit. 12 is what we would have got in a well-managed mutual fund. I'm at 9. I'm not doing too well. So I'm seeking counseling. And then if you can get a good counselor, start putting money into mutual funds or some large cap fund or something like that. All the repair money you put there. It may not give you.
So you're saying the money that comes from repair, at least you put in mutual fund or some safer place. Let it compound and grow back.
Even in the mutual fund, don't put into silver ETF or something like that. Put into a safe big flexi cap.
So further erosion of capital should be arrested.
Absolutely. You may not get great return, but at least in the mutual fund, if you do a 5-year, 6-year SIP in a, say, a BAF or a multi-asset fund, I don't think you can get negative returns. So anybody who comes to me, and there is one lady who says, oh Subra, if I invest through you, I never lose money. It is her behavior from 2007 or 2008 to 2025. She has never removed money, which is what is giving her great returns. It may not have been top quartile performance or somewhere there, but she's still not lost money. That is the biggest thing you can do for yourself. Don't lose money.
And never forget that.
Never forget that. And when I'm saying don't lose money over long periods of time, right? So set it right by getting your family involved. It is their money.
So repair begins when the ego accepts that you're wrong, recognizes that something needs to be done, exits whatever it considers a mistake, creates liquidity to be invested elsewhere, hopefully invests that money either in his own other ideas which are winning ideas or in a mutual fund ecosystem, so that repair and recovery happens independent of his own investing, which he is doing personally.
Oh, Shyam, I may be old-fashioned, but I can't put in a reasonable amount of money without speaking to 2-3 people.
Okay.
In the WhatsApp
That
group,
everyone is like that.
we are like, I can't go online and buy something because somebody told me. I have to still call up somebody in Bombay, somebody in Chennai, and say, hey, what do you think of this? Is the management good and all that? So having, I keep saying this, that having 2 good people to whom you can talk is worth 2 months
very
research effort.
important. It's most valuable. I agree with you.
If you don't have that, then direct equity becomes a nightmare.
Absolute nightmare. Agreed. Totally agreed.
So don't do it unless you have these 2 people whom you can talk. It could be
And those 2 people, how will they help you manage your ego better?
Correct.
How will they? Tell me.
No, they will tell you, are you an idiot? Stay away. So you have to respect their views also. There is no point in...
and you have to bring those people into your life. They will not come on their own, right?
They may not come on their own.
They have better things to do.
No, and they may think, why should I give you advice?
Correct.
Advice has to be sought. The first thing I learned when I did CA, first day, we were part of a foreign firm. So they had said, people have to seek advice and pay fees. Otherwise, it is free advice, which is ignored.
If you go and give it voluntarily, it's free advice.
It is free advice, and
it's not respected also. That's the bigger part. It's not even the...
They already say, oh, my husband told me,
they will argue with you.
They'll argue with you. Then you also lose. Why do you want to lose your head over somebody who's not interested in your advice? So if people are interested in your advice, then only you can give advice.
Subra, there have been many occasions when the ego tends to drive your decision making. I have also seen it. I felt it. It's when we make our investment decisions deeply personal. What came out in this video is make it impersonal. That's the only way you can keep your ego in check and you can allow your decision making to succeed, because the ego tends to disrupt your behavior in a way which makes decision making inferior. So the key thing should be, at all times we try to improve our decision making and keep the ego in a position from where it helps us make better decisions. And this simple idea is so difficult to practice, mainly because we allow our ego to run ahead of us, and then we go chasing it, and then end up in the wrong place from where there are no comebacks. So timely control of the ego and timely correction of egoistic decisions is something that will take us a long way in investing, and I'm sure you have experienced this. I am experiencing this too. And learning this is very important for every investor. I'm sure this video, when watched by a number of investors...
I'll also tell you, when your children look at you and they think, oh, you've done a great job, telling them about your mistakes keeps them more secure. They think, oh, we can also make mistakes. Our fathers and mothers have also made mistakes. And I see fund managers, one of the greatest things about some fund managers is their humility.
Correct.
Say, oh, Subra, what
they talk about their mistakes.
They talk about their mistakes. I have made many videos on my mistakes. You make mistakes, accept it and come out. Don't let your ego hurt your purse.
Correct.
That is the first thing.
So on that note, we'll close this video. Don't let your ego hurt your purse. Repair decisions which are relying on ego and not supported by fundamentals soon enough, so that those decisions don't hurt your wallet. Thank you for watching this video, and thank you, Subra, for this wonderful conversation.
My pleasure.